Hello traders, it's August 21st and we're watching the ES futures here. I wanted to provide a quick recap about an opportunity I saw today, and it has to do with a confluence with the 10-year yield. This is going to be a little bit about order flow and a little bit about correlations. I think it's a great way to add conviction to a setup and give you all the more confidence that you can put a trade on and hold to that plan because you have a great thesis behind it. So let's look a little bit at the order flow and just the intraday structure. We saw some intense selling pressure throughout the morning and into the kind of late morning here. And I want to call specifically out that we had high volume and very strong selling pressure into this kind of 86 to like 83 range. And this heavy selling pressure did kind of hit a stopping point here at about 83.75. And price tested this area multiple times, and we began to see what could potentially be a reversal, maybe some seller exhaustion. Some aggressive buying did kind of start to come up with some V-shaped recoveries off of this level, and it started to look pretty good because we had sold off so substantially. We were in sort of a larger time frame, a bit of a bounce in the markets. And so this oversold state did provide some opportunity to potentially get long. However, it didn't ultimately bounce that far up. And a lot of these buyers that were trying to buy this bounce down here found themselves in a bit of a hot water when price failed to progress and we moved lower. Past this inflection point. So this 43.83, this is going to be an important one that we will return to here in a moment. I'm going to back up just a little bit on the recording here. So this was one of the key moments during this setup, was looking for downside pressure to continue and set up an area of interest. We have the inflection point that buyers are defending. And so far, price has been unable to get below that. So for me, I was looking to see this occur first. We saw heavy selling pressure, some stops being hit. All of the activity at this point, if people had stops just below this, they just got hit and taken out. And so it meant that we were finally going to see some further market development up or down. I'm going to speed this up, and we're just going to fast forward through some price action to the next area of interest. So we did get a retest and a rejection of this level. That is a potential kind of breakdown, retest. There's some potential for a setup there. It's not what I'm going to be talking about today, but it is a good opportunity in the right environment. So because we ultimately failed and saw price move away from this area, this inflection point becomes valid for my strategy. And at about 8:30, what we're going to see is price is going to retrace. It will come back down again, and it's going to retrace. So while the market's going in the background, I want to talk about the confluence with the yields. So we have the 10-year yield here. Let me bring this into frame. We have the 10-year yield, and the treasury yields have been reaching new highs as of late. And for those unaware, these treasury yields are now at in the 4% range. And this range means that someone can put their money in a fixed income treasury yield, and they can earn this percentage on their money. The higher this goes, the more likely it is for an institution or an investor to just say, I don't want to deal with the risk of the market. I'm just going to put my money in a place that I can guarantee a return. So as the yields go up and they become more lucrative to people, that means that downside pressure will be applied to the markets because people are less likely to put their money in a risky situation, and they're more likely to put it into an area that has a guaranteed return. So let me pause this here. What we saw was at about 8:30, 8:33, the yield was breaking to, 10-year yield was breaking to new highs, meaning it has never been, at least in recent times, it has not been more incentivized to pull your money out of the market and put it in somewhere safe. And this was occurring after a bullish move up. So we saw yields moving up, creeping up at the same time that the market was moving up. And this looked like a great opportunity because with the break of the high, that has a high probability chance of putting downside pressure on the market. And we're coming into this inflection point where we have aggressive high volume selling, multiple tests, a failed level, and we have what I like to see, which is not only do we have aggressive selling above it, but we have aggressive selling below it, and we have aggressive selling that is actually moving price away from that area. So this area offered a great risk to reward in confluence with the yields and the downside pressure that could be put on the market. So we'll go ahead and play from here, and I'll go into 2x mode. So we see big buying come in, and this is right when the yields were breaking the highs, and we get an attempt to take this level, but ultimately it fails. Just speed this up a little bit more. And so as soon as this pressure starts to mount, that's a great opportunity to start to scale some in. And as this price just starts to puke out lower and your thesis validates itself, continuing to scale and add. And so this is what I wanted to talk about, was using market confluence, the yields and the downside pressure in conjunction with coming up to an inflection point to create a high probability thesis. So I'll just make a mark here. So, entry in this area. And then we saw the market continue to sell off. And this type of activity, I think if yields had continued to run a bit hotter, could have resulted in a larger downside move today. It did not. But this thesis was still good for about a 10-point move, and it offered really tight risk because of this inflection point. And so that's why I'm giving it kind of a high quality A+ opportunity in my book that I wanted to talk about today. I hope everybody had a great day, and I'll see you soon.